This is the Wiser Weekly Roundup, where we take 5 topics over the next 20 minutes. These 5 topics we get from client questions, also just things that were in the financial news. We'll get right at it. I'm here with Matthews today. Hey, Matthews.
How's it going? Glad to be here. Missed the last one, but looking forward to these moving forward.
Brad did a good job, though.
Yeah, I enjoyed watching that.
He carried me pretty well. First topic, interest rates are going up. So I'm hearing mortgages. People are freaking out. They're having to pay over 3% for a 30-year mortgage all of a sudden.
We've gotten spoiled lately.
We got spoiled, yeah, for the last couple of months, it seems like. What are you seeing?
Yeah, so, I mean, last year we hit historic lows in interest rates, so now there's really only one way it could go besides going negative like it did in Germany and other countries. But we started to rise this year and over 1.5 for the 10-year. I guess to explain kind of how that relates to what we discussed with bond prices is that there's an inverse between bond prices and yields of interest rates. So now that we're seeing the rates go higher, unfortunately, that's hitting some bonds, and the bonds are struggling a little bit this year. So that's kind of what we're seeing right now is the inverse relationship with the rates going up and, unfortunately, with bonds going down right now.
So as yields are going to be increasing, so the interest that you get from a bond goes up, the price will also go down.
Correct.
Inverse relationship.
Yep.
So when you look at your portfolios and all of a sudden we see the bond side, which is supposed to be the secure side, starting to decline, I think clients get a little nervous because that's supposed to be the rock solid foundation. But if you look at this over a long time period, this is natural. This is healthy for something like this to happen. We're coming out of a very trying time where interest rates had to be very low, but they can't stay low forever. That's not healthy for the economy. That's not healthy for investors.
Right.
So if you think about it, a bond fund, typically bonds filter out. So if a bond is intermediate term, it's going to be selling bonds potentially at a loss because of the price coming down. But at the same time, it's buying new bonds at these higher yields. So over time, it kind of filters through the bond portfolio. Obviously, the shorter durations, the shorter maturity period that you have, that was going to help insulate you from radical bond prices. So, we have a mixture of short-term, intermediate-term, and then long-term bonds in our portfolios to kind of help stabilize all that. But on average, you want your maturity right now probably be around somewhere between 4 and 6 years.
Right. You're seeing the biggest issue with this with long-term bonds over 20, 30 years that have been significantly affected. But it kind of goes back to the point of why you're buying bonds. You're buying it for safety of principal and some income. So we haven't been getting a lot of income. We're getting 1% yields maybe on a good day. So it's been nice, or it will be nice in the future moving forward. We actually start getting a few percentage points on your yields on those bonds.
What would be nice is when savings accounts go back up again, because this has a direct correlation with that too.
Right. So
instead of getting 0.2, maybe we're going to get 0.5 soon. Maybe that becomes 1%, some of the online banks. Maybe 2% where we were before COVID. So this is not a bad thing. It's just a cycle happening in the market, and it's nothing that you would trade on necessarily or should be fearful of.
Yeah, just a short-term change. It's a little different than last year, but in the long term, it's probably beneficial.
Let's talk about the NASDAQ and the volatility happening there. That's been interesting to look at CNBC and see Dow up, 30 points, NASDAQ down 350. You don't see that very often.
No, I mean, last year especially, it was all about the tech stocks, the QQQs and NASDAQ and the work from home. So that was having record years, and everything else was hanging in there. But it was led by the NASDAQ last year.
Yeah, we saw what happened. We had the COVID crash, we had the recovery, but that recovery was really done by 24% of the S&P 500, which was the tech sector.
Right.
And it was carrying the entire market. They were going up so fast. I mean, Tesla up 700%. Amazon up. I don't have those percentages. Maybe you do, but those are very high double-digit returns. Amazon, Microsoft, Facebook. Anything that had to do with staying at home, Zoom, right?
The FANG stocks and then the new ones that came along during the work from home stocks were helping carry that along. They weren't the bigger names you'd heard of, but yesterday we had a good deal, a good market day with the NASDAQ. It was up actually over 4%, which is good. But before that, we had actually gone into correction territory this year from the highs. We had dropped over 10% already. So we're starting to see a little bit of pullback there. Whether that's moving away from the work from home stocks now that the pandemic starts to ease up a little bit, or moving towards more tilted towards more value and cyclical stocks moving forward. You mentioned the work from home stocks. They were kind of along with the FANGs pulling us along last year. Zoom's down 3% this year. Teladoc's down 1%. Slack a little over 3%. But the big one, Peloton's down over 23% this year. That was the big work from home. Everybody was going to buy a Peloton. This was the new IPO, the new big stock. And, you're starting to see a pullback there.
Yeah. I mean, I guess they assume people are going to be going back to gyms and be doing less workouts at home. I don't know if that's going to happen that fast, but the market runs in anticipation of the future, not what's happening today.
Right. Probably a little correction. I mean, that was pretty significant gains there last year, kind of reversion to the mean a little bit.
But at the same time, you have tech selling off, but then you have all the other stocks that have been left behind for the last year, even maybe year and a half. Those stocks are now starting to rise. So it's just a shift overall. And plus, going back, I'll borrow from the first topic for a second. Anytime you have an increase in interest rates, meaning the 10-year Treasury, anytime the 10-year Treasury starts yielding higher, it resets everyone's calculations in money management. So your risk-free rate, which is the 10-year Treasury, if it was 0.7 and now it's 1.7, some people will decide, I'm not going to be in stocks. I'm going to take the 1.7, and so that the market's going to have to sort through that over the next few weeks, if indeed we stay at those yields, which we probably do unless there's another event, right?
Right.
I mean, you can get a COVID shot in 1 day now. So
they're saying they're readily available by May, so for everybody. So
right.
Over the next few months, we should see a change in all that pent up demand everybody's been talking about for the latter part of this year moving forward.
Speaking of COVID, let's talk about the anniversary. This is the month of the big COVID fallout.
Yeah, I remember this time last year, we've got the golf tournament, the Players Championship. My girlfriend and I were going down to visit her sister and brother-in-law and niece and nephew. Got to the airport and found out that the tournament was no longer going to have fans anymore. Went ahead and flew down there. While we got there, we found out that the tournament was canceled and the season was indefinitely suspended. Kind of the beginning of what happened after that was, the actual beginning of quarantines, lockdowns. Nobody knew exactly if that was going to be for a few weeks or months, and we've obviously seen it's been a full year of craziness. But that was also, for the markets, was a wild time. You were seeing the 7% daily swings. The circuit breakers had to be enacted in the stock market where they actually had to pause trading due to those volatile movements. But this was also when it started to get closer to the bottom. March 20th was actually the bottom of the stock market. But this was when we really started seeing all the volatility, and we really started getting a lot of calls from clients as well as prospects starting to figure out, is this the end of the world? What is actually going on right now?
Yeah, I think from an investing perspective, there's so much to be learned or reminded. These are all things we should know already, especially as professionals. Is in that crisis, that's you don't panic. You have to stick to your goals, stick to your portfolio objectives. I mean, two things are going to happen. Either it was going to be the end of the world, in which case portfolio management really no longer matters at that point. Or is this going to be one of the best buying opportunities we'd seen in a long time? And it proved to be the best buying opportunity. I feel like we straddled that right in the middle. I wouldn't say we made drastic changes. We didn't make any drastic changes to the portfolios, but we did do a massive rebalance near the bottom of the market, which I want to say was just ingenious for us to call that, but really it's part luck, right?
Yeah, we weren't trying to time that perfectly. We got pretty close to it. We're lucky, but just knowing that the market was significantly down and it was a good time. It could have been months down the road, but it was a good time with those 20-30% pullbacks where to start reevaluating, rebalancing some funds.
Yeah, I called the whole time the advisor Super Bowl, because that's what we were hired for. When things get hard, that's when you answer the phone, especially fast, return emails especially fast, because people are concerned and they have great fear, and you have to be strong. You have to stick to what we know, what we've been trained to do, which is focus long term. And if there's not a long term, then it doesn't matter anyway, right? So I think that for me personally, I was proud of how we handled it here. I kept coming to work. I'm not one necessarily to follow society rules, I guess, but our office were pretty spread out, so you're still not necessarily near anyone. But we kept coming in here every day and just kind of grinding out newsletters and coming up with ideas like what we're doing now, and just use that quiet time to kind of reinvent some of the things we've been doing here, and then also to stay when it got not so quiet near the bottom, to make sure that we were getting out information to everyone.
That was a quick turnaround, though. I mean, that's I think that's what people struggle with. Not only was it these huge 30% drops, it was that it was happening over a few weeks or a month's time. That was kind of scary for a lot of people, especially those in retirement or close to retirement.
Yeah, well, again, that's why you keep emergency reserves. That's why you keep portfolio reserves if you're doing withdrawals. And I always tell our clients, we planned for some catastrophic event during retirement, or even while saving for retirement. So, you can get one of those, and if it never bounces back, you're still okay. And we bounce back, so we get another one.
Yeah, I mean, if you look at it now, since that bottom on the 20th of March of 2020, the NASDAQ's up 84%, the Dow 69%, the S&P 68%. So that's a pretty significant swing there that as long as you didn't sell, you were able to move forward in the market with those gains and not actually realize those losses.
Imagine all that 401k money that was able to get in during that time, and what your rate of return is on that. Depending on your payday. You're right. It happened so fast. It was hard to get
right
paycheck money.
But to your point, it was so quick. If you sold and got out, you missed that whole gain, the whole uptick there. So.
Yeah, if you tried to time it, that'd been very detrimental. So, yeah, we never try to time things like that unless you're buying. Then you just, it was obviously a great time to be hopping in. In hindsight, doing it, there's definitely some emotion involved that you have to sort of ignore. All right, let's move on to the next topic. I read an article in the Wall Street Journal about the government's cracking down on investment products or managers that are saying, hey, invest in this and you're saving the environment. ESG investing. We actually have a podcast launching next week about this topic, which I'm pretty passionate about.
Yeah, that was a fun topic to discuss. I think the biggest issue with this is kind of the new trendy thing that a lot of these big firms are marketing, that environmental, social, and governance funds. Not only are they having good returns, but you're giving back to the world and the environment. The only issue is it's so broad. How do you actually determine if something is an ESG fund or not? And I think that's where this becomes a tough issue. Is how are these strategies consistent with what they've disclosed in their funds?
Well, there's different companies ranking companies on their environmental, social, and governance, right?
Right.
And then, so you have different standards of ranking. Then on top of that, you have funds that are saying they're investing in companies that are have high ESG rankings. But the reality is that they may not actually be doing that. They're using it as a marketing ploy. It's a buzzword for today. And the SEC is realizing this, so now they're starting to go after companies. But I guess when I read it, I was like, well, who's going to define it? Because if the government hasn't officially defined it and the industry hasn't officially defined it, it's just a loose term. How do you get someone in trouble for I guess I'm preparing the defense
Yeah.
for any company that gets called out on that, which is to my point in the podcast is a lot of this is smoke and mirrors, right? If you want to do ESG investing and you buy an iShares large cap ESG fund, it's not that much different than the S&P 500, but yet it costs you, 5 times as much?
At least, yeah.
So to me, that's the problem. You're charging for ESG, and yet it's built very similar to the S&P 500, and it's costing you that much more. They won't get in trouble for that because they're going to say that, well, you're paying for this screen, this ESG screen, and this is BlackRock. I don't see them getting in trouble for this. It's I think other outlier players.
There's not a ton of regulation with this right now, so it's probably a good thing in the long run of actually forcing you to define what ESG is and having some regulation so that it actually is an efficient ESG fund and not just something that you're marketing as one and not at all aligned with that.
Yeah. Well, anyway, listen to the podcast. I could repeat the whole podcast here, but
we're not going to go into a whole hour of that.
I can't do that. All right. Next topic: small cap versus large cap. So, again, it's another article that I saw in the journal I thought was very interesting. So small cap stocks have outpaced large cap, right, year to date, and even
historically, basically.
Yeah, historically over the long term, but not in the last few years.
Right.
In the last few years, they've been underperforming large cap. So that has been I wouldn't say it's a concern necessarily. It's just that's a little abnormal. So a lot of people have been removing small cap from their portfolios. We are actually overweight a little bit in small caps, but it's not small caps actually just being better than large cap. It goes deeper than that. So small cap stocks are tilted toward value. Large cap stocks are tilted toward growth. Well, right now, value stocks are outpacing growth stocks for the first time in, I think, a decade.
Probably close to it.
So, which is fine. That we needed something to bring some normalcy back to value versus growth. Value's has a long way to go to catch up. But so what's actually happening, what could be happening in small cap, the reason why they're growing so much is because there are more value stocks in there than they are growth stocks. The second point the article made was growth, sector. So the sectors that are doing poorly in the large cap are underplayed in small cap. So on the large cap side, the technology part is obviously hasn't been performing year to date as well. In small caps, you have more financials and consumer stocks, which are doing well right now. But there's less of those in the large cap, relatively speaking. So that could be that it's a value growth play and a style play that's actually moving small caps to be outperforming large caps. So you just got to be careful in how you allocate, that you understand that you're not just buying all the small caps thinking that it's the tide rises with every single one of them.
We're also coming out of a recession, and historically, small cap stocks are the first to get hit and drop. They're also the first to recover. So it's basically what's happened is the small cap stocks struggled really during the beginning of the recession, the quick recession we had, and then they've had a quick turnaround after that in 2020, and especially right now over the last few months, beginning this year.
Yeah, and there's a lot of historical data that supports that. So that's a good point as well, which I guess would be our third reason why maybe small caps are outperforming, is that money is just rolling into them because that's what's supposed to happen after what the fastest recession ever.
Right.
Right.
I mean, historically, that's how it works. The only time in the last 4 it hasn't is July 81 and through November 82. The 3-year turn was slightly less at 15 versus 18 compared to the Russell 1000 and 2000. So other than that, the returns are better from small caps following recessions.
All right, Matthews, that was fun. We'll see you next time on 5 topics in 20 minutes. I think we did it.
20-ish minutes. I enjoyed it. That was fun. Look forward to it.
All right, see you guys.
See ya.